All right, I'm going to continue walking through year 2 of the JPS example, and they have a lot of transactions this year as well. So we'll try and explain what those transactions are as we go along. But you can fast forward and fast reverse to go over the parts that might seem a little fuzzy in case this thing gets where it seems like it's too long. All right, so in year 2, remember year 1 JPS, that's when they got started. Year 2, the balance sheet, we actually have to pull the numbers from last year because a balance sheet is at a particular point in time, which means that it's cumulative. It'll include everything from year 1, everything from year 2, everything from year whenever. It's an ongoing aggregate number, as opposed to the income statement and the cash flow statement. Those are per year, so there's a separate one for every year. They're not cumulative. So to go get the cash from at the end of year 1, I just go down to the sum, and the sum number here is the grand total of all the transactions during the year. All right, so we had cash. There were no accounts receivable yet. We'll see those in year 2. We still had 6,000 of inventory. We had bought 14,000, sold 8,000 of it. So we still have 6,000. We just bought some land. So my total assets, what I own, starting out the beginning of year 2 is the same as it would have been at the end of year 1. Similarly, I go in there and go grab the information for the liabilities and equity. And again, we didn't have any accounts payable or notes payable, but we will in this next example. All right, in year 2, there are examples there. Okay, so my balance sheet still balances 18,000 assets, what I own, 18,000 liabilities and equity, where I got the money to buy the assets. So far, it is all equity. Got $15,000 from somebody who bought an ownership stake and $3,000 that is revenue net of expenses, money the JPS earned over the course of year 1. All right, so let's start with the events in year 1. Event number 1, they borrowed $4,000 cash by issuing a note payable. All right, so cash goes up by $4,000. A note payable is an IOU. I borrowed money, call it from the bank, for notes payable, and now my balance sheet still balances. That's not a sale to anybody. It's simply I go out there and borrow some money. So now I have $22,000 in assets. 18,000 of it is owner's equity, that is common stock and retained earnings. And the other 4,000 is borrowed money, or OPM, other people's money. All right, moving on now. My cash has gone up from $6,500. Now it's up to add that $4,000 of cash. I got $10,500. Let's go to transaction number 2. Again, I'm going to save the cash flow statement for last. All right. JPS purchased on account merchandise inventory with a list price of $11,000. Purchased on account. That means that we borrowed the money. But instead of borrowing from the bank, we borrowed from the person selling us the stuff. So somebody sold us $11,000, and instead of asking for cash, they let us have it on our good looks. We didn't even have to sign a note. So business-to-business purchases are frequently made on the basis of an IOU. Here's the inventory. We'll come back and settle up at a later date. All right, so my balance sheet still balances. Look at all those assets now. I started the year with 18,000. Now I've got 33,000. An additional $15,000 in assets. Great. Where'd I get the money? 15,000 of borrowed money, 4,000 borrowed from the bank, 11,000 borrowed from my supplier. Okay, so after I borrow this stuff, going to item 3, I found that some of the crap that I bought, I don't like this, it's the wrong color, what have you. So I took it back to the store. So I take it out of inventory, take it back to the store, and it comes off of the accounts payable. All right, they just say, okay, you owed us 11,000, now you only owe us 10,000. Okay, so just like when you buy crap from Amazon and decide you don't like it and you give it back, they give you a credit on your credit card. And that's a good way to think of accounts payable. It's essentially a credit card. So you'll have to settle up at the end of the month or the end of the accounting period, but you put it on a credit card. And then you don't like something, you take it back, they take it off the credit card. All right, so that gives us through item number 3 or event number 3. Event number 4, JPS received a cash discount on the goods purchased in event 2. Okay, cash discounts, it's interesting. We'll give you a discount if you'll pay us early. Your book points out that some companies they essentially charge you extra if you don't pay within the discount window. All right, either way, whether you call this a discount or a surcharge, really it has the same impact. If you pay within 10 days, and that's what that 210 net 30 means, the discount terms are if you pay within the 10-day window, you don't have to pay the full price. You only have to pay us the discounted price. So the discounted price means that we'll take $200 off of the cost of the inventory and off of your accounts payable, so you only actually owe me $9,800 during the first 10 days. Now, what happens if you don't pay it within the 10 days? And take that back off of there, and then you pay the full $10,000 you still owe them, okay? All right, so either way, if you pay within 10 days, you're going to pay $9,800. If you pay after day 11 up to day 30, you owe us $10,000. All right, that's the $11,000 net of the return. So now you only owe $9,800. All right, and now JPS paid the $9,800 that they owe. That means that my checking account goes down by $9,800 and the accounts payable goes down by $9,800. Okay, so my balance sheet still balances. I still haven't sold anything to my customers yet. I'm just getting inventory on the shelf so that I can. All this ash and trash in there about the effect of inventory. The main thing we want you to keep track of here is the idea that when we buy inventory and buy it on credit, and then we take something back, well, then they take it off of the bill. All right, just like the credit that you'd get on a store credit if you took stuff back, and they'll just reverse part of the charge on your MasterCard. The $200 discount. Now, why do we keep track of that? Some companies actually pay the discount or take the discount, and some companies don't. And at the end of the year, you know, $200 here, $200 there, it can add up into real money. Accountants keep track of everything. Remember, this is how we keep score. An important part about keeping score, let me use an analogy, keeping score on a football game. At the end of the game, somebody will report a total score, but that's total points scored. Let's say a team tried 19 field goals. They tried 19 times, or only successful on one of them. Then their score will show 3 points. But we would like to know that they tried a bunch of times and didn't succeed. And that's why accountants keep track of everything. It's important when we're managing the firm or managing the football team to know how many shots there were on goal, how many times a batter swung at a ball, how many times it was chipped foul, how many field goals were missed. It's not just what the end score is, which is all you're going to get from the balance sheet. It's how many shots did we try, how many times did we try it. So there's a lot of detail in accounting information that you may think is superfluous, but when you start managing a firm, you want to keep track of everything. All right, so let's move on to